Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Stacey in Jacksonville, Florida.
Hi, this is Stacey from Jacksonville, Florida. I have a question that I can't seem to find an answer to. After completing a Roth conversion in 2020, and now it's 2021, should we repeat the same process for depositing funds each year thereafter, meaning first deposit the funds into the traditional and then wait a few days and do that transfer from the traditional IRA to the Roth? Or is it okay to just deposit your money directly into the Roth? You already made the conversion in the previous year. What is the correct way to do this? And then if you learn that you put the money in the Roth incorrectly, what should you do about it? What do you do next? How do you get the money back to the traditional? How do you fix the problem?
Thank you, Stacey, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, so I've said this on the podcast before. I'm really wary of like talking about backdoor Roth conversions and those types of things related to this, just because I think that a lot of bloggers, a lot of resources make it appear to be easier than it is. It's like, oh, you just fund this account and then move it in the other account, and unfortunately, it's not that easy. So what I want to do, Stacey, is break down like the question about process. You said, hey, should we repeat this process? And I will say this is potentially an annual thing you're going to do. So it's not like you do it once and then, the floodgates open and money can go automatically into the Roth. You definitely have to do it on a kind of transaction by transaction, so to speak. And then the second thing is like, what happens like if you feel like you've messed something up, like how do you back it out? So I want everyone to bear with me a little bit. And I'm doing this because I'm going to go through a kind of an involved example, because I think it just illustrates what can be a little bit of a complexity that I'm talking about. So the first thing that you're going to do when you're looking at this type of strategy is you want to determine what your AGI is, your adjusted gross income or modified adjusted gross income. And this is tough, right? Because if you're trying to do this on the fly, you don't know, like if I'm contributing to, my traditional Roth in 2021, I really might not know where my AGI is going to fall until the end of the year precisely. So if we assume, Stacey, that you are single, the phase out to make a Roth contribution is $140,000 for your AGI. So the idea is, and I think it starts at 120. So if you make 125, I'm sorry. So if you make $124,999 and you're single, you can put all $6,000 into your Roth. No questions asked. Once you make $140,001, then that door closes completely. So you can no longer directly contribute to the Roth. So that's where you do the non-deductible contribution into the traditional and then move it over. So really the first thing is to determine what your AGI is. The second is, if you determine that you're over that 140,000, then you would contribute to your traditional IRA. And that would be kind of what we call, it's kind of like the pass-through account. So the one thing that you have to keep in mind, it's called the step transaction doctrine. So what the basis of this is, if the two steps of a conversion are completed within too short of a time frame, the IRS may determine that they were really part of one transaction. And in this case, the IRS would consider the transaction to be a Roth contribution and not allow it. So the example here, Tim, would be if I contributed April 1st to my traditional IRA and basically move that over the same day, then the IRS could look at that and be like, that's not two separate transactions from the traditional to the Roth. That's one.
Mm-hmm.
So not allowed. So the question is, well, what do you do? So there's different ideas out here of what you should actually do. I've heard that you should wait a full year between the contribution and the conversion. So you would say, hey, I'm putting this, contribution January 1 into my traditional, and then January 1 of the next year, I'm going to actually do the conversion. I've heard a month is sufficient. So I think it depends on who you talk to. I think it depends on who at the IRS is actually looking at this. And we know people interpret things very, very different. So that's one of the rules you have to be worried about is a step transaction. So you determine your AGI, that's step one. Step two is you contribute to the traditional IRA. And step three is that you basically move or convert that account or part of that account to the Roth IRA. So just to back up, everyone can make, if you have earned income, everyone can make traditional IRA contributions. Not everyone gets the deduction. And most people that are listening to this are not, unless they are students or they are residents or fellows. Most people are not going to get the deduction, but they can contribute. Whereas the Roth, if you make too much money, the door closes and you can't contribute. So the other big rule that is a little bit more complicated is called the aggregation rule. So the aggregation rule, basically what that is, you have to take all of your traditional rollover, SEP, simple IRA assets and determine the conversion associated tax. So this is one that's often overlooked. The first example of this is, let's pretend, Tim, that you don't have any of, like, all of those accounts that I just rattled off, you don't have any of those. So you make 150,000 in wages. So you're ineligible you're single, you're ineligible for the Roth IRA contribution.
Mm-hmm.
You can make a contribution to the traditional IRA that's non-deductible. And basically you can then move that after waiting a certain amount of time, you can then move that to the Roth without any tax consequences. So that's a very vanilla example. Let's pretend, though, that you have $200,000 in these different accounts, the traditional, the rollover, the aggregation. So that what that means is that a $6,000 non-deductible contribution to the traditional IRA that you're trying to convert to the Roth IRA is problematic. So that conversion is subject to the IRA aggregation rule, and the tax consequences are determined on a pro rata basis across all the accounts. So what this means is, if you have $200,000 and you're putting another $6,000 in, you have to take that $6,000 contribution and divide it by $206,000. That equals 2.9%. The conversion of the new IRA will be treated as only $174 of after tax and $5,826 of that $6,000 contribution of pre-funds that are taxable at conversion.
Mm-hmm.
What that means is, if you are doing these backdoor conversions by yourself and you are ignoring a traditional, a rollover, a SEP, a simple IRA,
Right.
then we're messing something up here. And that's often the case. So the step doctrine, that can be a little bit easier if you can wait a month, a year to do. But it's the aggregation rule that typically trips people up in terms of like what is taxable and what is not as I'm doing these conversions.
What is the cleanup like, Tim? Like when that happens, I mean, like what's the cleanup like? I'm messy, right?
That's a good question. That was kind of one of Stacey's question is like, okay, if I have the process down, let's pretend I put money incorrectly. Like, how do I get that out? How do I fix the problem? The problem is, again, if you're doing this yourself, and we've had clients that have done this themselves, and then we've tried to help them unwind things, the custodian that's holding that, so let's pretend it's custodian A. The first thing that and you call them up and you say, hey, custodian, I have this Roth IRA that I did a conversion on. I think I messed it up. They are not going to advise you at all. The stock answer is going to say, talk to your accountant, because they're not going to give you any investment advice. They're not going to give you any tax advice. So they're going to say, talk to your accountant. We can't really advise you. We can do what you ask us to do. So it's very transactional, but they're not going to sit there and say, okay, this is what you need to do, blah, blah, blah. Now, there are things that you can do to back out. So you can back out Roth contributions and move those back into either traditional or you can journal those over to a brokerage account, but there could be tax consequences on gains that you saw when the account's there. So it's complicated. So that's one of the reasons why I'm like, don't do this yourself. Again, obviously it's I'm biased here, but the problem is if you do it yourself and you're trying to unwind it, the custodian is just that. They're just there to custody the investments. They're not there to advise you on taxes or investments. And if they do and they're wrong, that puts them at risk. So to me there are ways to undo these, back contributions out and get them in the right accounts without penalty. It's just that you have to figure that on your own. And unfortunately, until we actually see like the case, your case, Stacey, like there's no way to know. So it really depends on what that contribution looks like, if there's gains, what is the aggregation rule state, all that stuff. So that is really why I kind of get queasy when talking about this in this forum, because it can be a complicated transaction.
Yeah, and I appreciate that comment, Tim, because we have put together a couple pieces of content related to this topic. We did a podcast episode 96 about backdoor Roths. We have a blog post, we'll link to both in the show notes, about pharmacists doing backdoor Roths. And we toiled over those for a while for the exact reason you're mentioning. It's a fine balance of like, we want to make sure people are educated, they're aware. We get this question a lot, and it could be a viable option for many people. But we also don't want folks to falsely assume like, I can just open up an account, make a couple clicks, and I'm good to go. So, whether it's making sure you dig deep, working with your planner, with your tax professional, we'd love to have an opportunity to do that with you as well if this is something you're interested in doing going forward. But great advice, Tim, I think, just on the complexities and how sometimes something like a backdoor Roth can be oversimplified, and really the importance of understanding the different nuances. So, Stacey, again, thank you for taking time to submit your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist podcast. And as a small thank you for submitting your question, we're going to be sending you a super comfy YFP t-shirt. And to those listening, we would like to hear from you with your question. You can head on over to yourfinancialpharmacist.com/AskYFP or send us an email at info@yourfinancialpharmacist.com. Have a great rest of your week.